On Wednesday, July 27th, the Federal Reserve had announced its second consecutive 75 basis point rate hike. At the same time, though, they cushioned that move with softer rhetoric, leading some to believe that the current hiking cycle may end sooner than we anticipated. U.S. two-year Treasury yields fell from 3.1% on the 27th to a low of 2.8% on the 29th. For the next 2 days, they traded around 2.9% before moving higher on remarks from San Francisco Fed's daily saying that the Fed's work on inflation is nowhere near almost done. The market is now awaiting significant economic data on Friday with the unemployment report and then the massively important CPI number on August 10th. The Fed has recently found themselves in a difficult spot as the most recent read from the U.S. GDP report revealed 2 consecutive quarters of negative growth, while at the same time there's been no hard evidence that consumer inflation is slowing down. That being said, there is some anecdotal evidence that the worst of inflation may be behind us, as the RBOB gasoline futures have fallen 23% since June 10th, and we've observed some similar moves in other traded commodities. CME Group's FedWatch tool now is forecasting a 66% probability of a 50 basis point increase at the September Fed meeting, which is down from 71% on Monday, August 1st, but up from 50% a week ago. At the same time, probability for a 75 basis point hike has risen from 29% to 34% since that August 1st date as well. If a trader believes the Fed will continue to aggressively raise rates as a response to the pervasive inflation and that two-year yields could rise from here, they could express that by buying the August micro two-year Treasury yield futures contract at 3.00 and target a move up to the June highs of 3.47. A stop for this trade could be placed below at 2.80. This trade could make $470 if your target is reached and risks $200 if you're stopped out of your level. Now, if a trader believes that inflation concerns could soon give way to recessionary concerns and that the Fed may soon have to pivot, they could express that by selling the August micro two-year Treasury yield futures contract at 3.00 and target a move to May lows at 2.55. A stop for this trade could be placed above at 3.25. This trade could make $450 if your target is reached and risks $250 if you're stopped out of your level.